In 1873, a farmer in Ohio named Samuel Benner was financially ruined. A massive economic panic destroyed his livelihood, leading him to wonder if these disasters followed a logic he couldn't see. He began tracking historical prices, looking for a pattern in the chaos. He realized that economic booms and busts weren't just social phenomena, they were tied to the physical world. He specifically tracked the prices of corn, hogs, and pig iron, matching their cycles to agricultural output and recurring solar rhythms. In 1875, Benner published this chart to forecast these cycles into the future. It successfully anticipated the stock market crash of 1929, as well as the 2008 financial crisis, by identifying the points where industrial growth hits its natural limits. Today, that same 150-year-old forecast identifies a major milestone for the year 2026. It remains relevant because while our technology has evolved, human psychology and the finite nature of physical commodities have not. The cycle suggests we are approaching a point where our growth targets will face a physical ceiling. To see how we got here, we have to look at the current market. Much like the retail margin debt that drove the 1929 bubble, today's exuberance is focused on AI software, a sector where valuations are rising based on the promise of infinite scaling. However, there's a distinction between these two eras. The 1929 crash was a crisis of unbacked kibber speculation. The tension in 2026 is driven by the fact that our digital ambitions are outstripping our physical manufacturing capacity. We aren't tracking the price of pig iron and corn to find the current ceiling. Instead, we look at raw silicon, the national energy grid's capacity, and data center infrastructure construction. The 2026 peak marks the intersection where the speed of AI development meets the structural capacity of the modern industrial base. Benner's chart is divided into 3 rows. Row B represents good times, periods of peak euphoria and high asset prices that occur every 8 to 10 years. For 2026, the specific instruction on the chart is to unload and sell. Row C tracks hard times, the trough periods where prices reach their floor. These occur in 7 to 11-year cycles. This is designated as the phase to accumulate assets, with the next major bottom scheduled for 2032. Finally, row A marks panic years, intervals of extreme volatility and macroeconomic shocks. These occur every 16 to 20 years, with the next designated panic year hitting in 2035. In 2026, the primary physical barrier is electronic design automation, or EDA. Currently, AI chip complexity is growing by about 50% every year. However, the design productivity of the human teams and software tools building those chips only improves by 20%. This widening gap forms a scaling wall. While we imagine more powerful AI models, we're reaching the limit of how fast humans and tools can actually design the hardware to run them. This data illustrates the workforce side of that bottleneck. As transistor counts in chips like the Apple A series skyrocket, the number of electrical engineering degrees awarded in the US is sharply declining. We are trying to build more complex systems with a shrinking pool of talent. The financial stakes of this shortage are immense. As this chart shows, the cost to design a single 3-nanometer chip now exceeds $300 million. At the same time, the industry is facing a projected shortage of 67,000 workers by 2030. Because the cost of a mistake is so high, verification, the process of proving a design works before it's manufactured, now consumes up to 70% of a project's effort. The number of verification engineers required is now vastly outpacing the number of design engineers. The timing of this 2026 peak reflects the current tension between hardware supply and software demand. The global industrial base simply cannot scale fast enough to support the current explosive rate of AI growth we are seeing. Institutional capital is already shifting in anticipation of this peak. We are seeing a rotation away from speculative AI software and toward the heavy physical infrastructure required to support the next decade of growth. This strategy focuses on infrastructure moats. This includes investments in nuclear power, pipeline operators, and the EDA companies that hold a monopoly on chip design. These assets are protected by high capital requirements and physical scarcity. This visualization compares the valuations. While pure-play AI software is trading at extremely high multiples, foundational infrastructure companies maintain price-to-earnings ratios that are often well under 60. This suggests value is shifting. It is moving away from the companies that consume compute power and toward the ones that physically produce the energy and hardware that makes that compute possible. This leads to a specific strategic playbook. For 2026, as the boom reaches its absolute zenith, the cycle suggests taking profits and exiting high-risk, high-multiple positions. During the cooling period from 2027 to 2031, the priority is capital preservation. This is the time to remain defensive, holding positions in energy pipelines and physical monopolies that produce steady cash flow. 2032 represents the designated bottom of the cycle. This is the ideal window to aggressively accumulate value assets and long-term positions while prices are at their very lowest. Finally, investors must prepare for 2035. As a designated panic year, it requires a high degree of caution regarding sudden macroeconomic shocks or geopolitical shifts. The Benner cycle highlights a recurring economic friction, the moments when digital expansion is forced to wait for physical infrastructure to catch up. Recognizing these limits is how enduring wealth